continue the market conversation with our first guest. Joining us now is Richard Weiss of American Century Investments. Richard, great to have you on. I mean, we were just talking about it, right? The fact that so much of the market and investors in the market right now seem to be buying into this soft landing narrative. Do you?
Not really. I think everyone agrees we're landing, right? Whether it's soft or a full-blown recession is open to debate. But I think to some extent it's an academic debate. We're still leaning towards something nearer a recession. And you don't need me to, read off the litany of clouds on the horizon, right? Manufacturing in recession, inflation coming down, but still problematic. Lagged effects of monetary policy, et cetera, the debt to GDP ratio. I mean, we had a bunch of stuff to worry about. And this recent relief rally, if you will, in the stock market has clearly priced in the good news. But what are we celebrating? The end of Fed rate hikes and the fact that we won't have a recession? Huzzah! I don't see how that's cause for celebration, quite frankly. And, just looking at it the other day, the U.S. now has the dubious distinction of leading the rest of the developed world in two key financial measures: debt to GDP and price earnings ratio. And how you reconcile those two for the long term, I don't know.
It's a key point, and it's one we haven't really talked perhaps enough about. So given the fact that you're skeptical about what this landing actually looks like, how are you positioned for 2024?
Pretty much the same way we've been for majority of the past 2 years, which is leaning towards fixed income, cash, short-term, more recently longer-term fixed income. And if you look at the 2-year period, that's end of 2021 to the present, cash has outperformed stocks. So that's the S&P. I mean, if you look at equal weighted stocks, so you take out the Magnificent Seven, or you look at the Russell 2000, cash has stomped stocks over the 2-year period. And so we're sitting there for the short term. We just believe stocks have gotten a little bit ahead of themselves, potentially cruising for a bruising, if you will. And the market is just too calm, too chill. Look at the VIX index. Where is it? 12, 13 today? Back at pre-pandemic levels. It's quiet. It's just too quiet.
But at the same time, Richard, if you sort of bought into the S&P March 2020, say at those lows, and just kept dollar cost averaging in, last year aside, you've done quite well. So I wonder, a recession, if we get one, you say you kind of suspect one is coming, it doesn't necessarily mean a horrible stock market. So if the economic slowdown is going to be bad for stocks, what do you think is the canary in the coal mine? How will we know?
Oh, I think all eyes on the labor markets, right? That's not news. I mean, we're looking at it too. When you start to see cracks, in the jobs numbers, that's when the Fed's going to have to start coming to the rescue. And let's face it, this is going to be a tough year for political reasons and financial reasons. Just don't see how we're going to get any fiscal policy accommodation through. So if we do hit anything that nears a recession level, it's going to be hard to pull up before we land. It's going to be a hard landing.
In 2024, what does a crack in the job market look like? Are you talking about major job cuts or jobs numbers that are just coming in very weak? What does very weak mean in 2024?
I'll take the unemployment rate. What is it? The SAM rule, right? When the 3-month rolling unemployment rate reaches a set distance from the 12-month rate, look out. And that's been historically pretty accurate. So you get that unemployment rate moving up to, let's say, 4.5 pretty quickly. That's going to spell trouble for the market. There's going to be layoffs. That's going to slow down the consumer. And that's the main driver of what's been going on. And admittedly, we're in the majority. We've all been surprised by the resiliency of the U.S. economy and the U.S. consumer in particular. But that has not spread globally. We are one of the few developed economies where that's been true. Europe, a lot of the Far East, definitely harder landings than we're about to hit.